So, hello and good afternoon. I welcome you to today's Trading Spotlight webinar here on Friday. It's the 18th of December, 2020. And as you can see, it's Santa time. So this is my last webinar this year here in this Trading Spotlight webinar series. We'll see each other again in January next year. And I've prepared something, so just sit back and enjoy, and we'll talk to each other in 30 seconds. Okay, so that's it here. So if you're just witnessed this live, I hope you enjoyed the party. If you're watching the recording now on YouTube, please leave a thumb up here. That would be very, very nice. So today's topic, now we want to jump right into the action. Today's topic is the top 5 risk money management tips for your forex trading. In fact, it's the 5 top tips I'd say risk money management wise when it comes to trading in general. Let me just, by the way, have a look here, and then we'll go here. We jump right into the agenda of today's webinar. So first of all, the top 5s. Number 1 is trade with a stop loss. I think this is probably probably not such not so surprising, in fact, that trading with a stop is one of the main reasons why many traders fail if they do not set a stop, respectively. 1 second, by the way, something's going wrong here in the back end, at least at my end. Let me just see. Let's check this. So there we should go now. Okay, so yeah, trading with a stop loss, that should go without a saying, in fact. But beside that, there's also some adaptation of that. And this is, in fact, the second tip then, to actively trade, to actively manage your trading and work with an active stop management in this context, respectively, with a trailing stop. Plus, I just, before I started the webinar, I was thinking about probably we have to adapt this, or we have to give another detail here too. It's not just work with the trailing stop and secure some of your profits, but also taking partial take profits into account. In fact, we can, in fact, negate or put a negative force sign in front of working with the trading stop here when working with a trailing with partial take profits. But at the end, we're talking about the same issue. So it's the same metal. It's only or the same coin. It's only the other side of the coin. In fact, we are looking at. Then we have the third important aspect when it comes to risk money management: limit your use of leverage. What this means, we will dig into this here into detail on the third point. Then have realistic profit expectations, something we made a topic, in fact, in a Trading Spotlight webinar several months ago. Probably you remember our webinar on Monte Carlo simulations. What this is, I will give a short wrap up of the webinar in the past. If you watch this recording now on YouTube, I'll just check the description box for the link. I will share the link once we get to this point here in the live event now in the chat box. And then there's also a very important aspect, which is probably not taken into so many accounts. Let's say diversify your forex portfolio. I just it had nothing to do with forex, but today I saw a tweet on Twitter. There was someone who said, well, the approach 70-30 worked quite well in terms of portfolio diversification this year again. because you put 70% of your portfolio in Tesla and you're putting 30% in Bitcoin, or the other way around, didn't matter, and made a quite good profit, respectively, had a quite attractive yield on your investment, return on investment, in fact. And so this is not what we talk about when we talk about diversifying your portfolio, in fact. Over the last month, I think there was a question from someone in our trading spotlight community who came up with a question on pound sterling, if I'm not mistaken. And he asked whether it makes sense to short pound sterling. I'm not sure, but it doesn't really matter. And he came up with 3 or 4 pound sterling cross pairs. And the thing was that it was, I mean, it made sense. Every setup he presented made perfect sense. But the problem was, if he now shorts pound sterling in each of these 4 currency pairs, he risks to be over leveraged short pound sterling, because he's putting all eggs in one basket, if you want. And so this is what point 5 will be about, then, diversifying your Forex portfolio. Before we start, that's me. So Santa Jens. I don't want to dig too deep into details around my person. I'm trading the financial markets. Is probably of interest for you for over 15 years now. I started working at a bank first, and then I was a trainee there. After that, I realized that if I want to get into investment banking or into the world of trading, then I have to study first. And that's what I did. I studied mathematics and economics, in fact. And beside that, I was very not just process oriented, but it was, to me, it made perfect sense to look for a job which is already aiming to become a trader rather sooner or later, and to end finally in the world of trading. And so I started trading as a professional. Initially, I started trading as a professional trader at a stockbroker, big stockbroker, and learned trading from scratch there. It's not the classic way with trading as a retail trader and starting from there. But I started my retail trading beside my professional trading back in these days. And I'm located in Berlin, in Germany, and that's probably the most important aspect now when it comes to Admiral Markets. Admiral Markets, global financial service provider with offices around the globe, over 20 offices around the globe, and 1 in Berlin, in Germany, in fact. And so this is because I want to mention that. Licensed from several regulatory bodies. It's not just the FCA. Now questions may arise. Okay, well, what will Brexit bring? No worries for European customers in this context. There's also SISIC regulation, so there's no regulatory issues which occur out of that. But also there's an ASIC regulation for Australian market, for example. So you have a fully regulated and globally working and available broker, which is very interesting, especially for those right now who are not English native speakers. So many of you are fine with the English language, else you wouldn't be here. But why is that noteworthy? Because I worked in a bank, and I know when it comes to financial questions, you don't want to talk to someone who's not speaking your native language. It doesn't feel you probably do not feel comfortable about that. And that's noteworthy because once you open an account with Admiral, once you trade with Admiral, once you're an Admiral Markets client, you have a very good chance to reach someone in your native language, talk to him, ask your questions in your native language, and feel comfortable in all financial service aspects, in fact, and questions related to financial services and financial markets. And that's probably something which is very noteworthy, beside the fact that Admiral has a highly competitive offering when it comes to the DAX, when it comes to FX, when it comes to gold trading. You can look at whatever asset class you want. You will it will be very difficult for you to find a broker with a more competitive offering than Admiral. So check out the website, admiralmarkets.com, for further details. And now we want to start with today's topic and the top 5, my personal, at least, personal top 5 in terms of trade risk and money management, in fact. And the first bullet point we already pointed out is trading with a stop loss. Should go without a saying still. Noteworthy in this context. So if you plan to trade professionally, you have to trade with a stop loss. There are several ways to set stop loss. There's no question about that. But a professional trader will always trade with a stop. If someone tells you different, he's definitely not a professional trader. He just does not know what he's talking about, and you should stop listening to him all at once and just go ahead and talk to him about important things like the weather or something, but not about trading. Every professional trader will emphasize how important it is to use a stop loss in your trading, and so it's not really a tip or something, but it's a must. It's just like it's essential. You want to survive in the financial markets. You want to survive in the world of trading. Well, you have to trade with a stop loss, full stop, period. And well, let's go to the next point. So but let's dig a little deeper into a stop loss, because it's we could easily fill 1 hour with talking about stop loss, what kinds of stop losses and everything. I could easily talk about 1 hour about stop loss and how to set a stop loss, how to define your personal stop loss based on your trading approach, on your strategy, your trading. We don't want to dig too deep into this topic, but still give a little more details on this. So a stop loss, first of all, is a tool which allows you to protect your trades from unexpected market movements by letting you set a predefined price at which your trade will automatically close. So this is like your hard stop. You put it into the market after you enter the trade. You know where to enter it, because, or sometimes it's you enter the trade and you have already checked the box by setting the stop at a predefined price. In fact, so it's there's no difference between placing your order to enter a trade and placing your stop. It's probably something you should make a habit, let's say, if you trade. And but we want to now look at different types on how to place your stop loss in your forex trading, or in trading in general. So probably put this here in brackets, the forex, because it's trading. It's for all trading asset classes. It's the same. Working with a stop loss goes without saying. And there are several ways to place a stop loss. First is the equity stop. So for example, I risk 100 euro per trade. If you do that, it's perfectly fine, but there's one important aspect to consider. If you have this number in mind, or if this number is also a part of your daily stop, in fact. So just assume that you say, hey, I have a daily stop of, let's say, 500 euros. And with this trade, based on, for example, my trading journal, I know that this is one of my favorite setups. I should trade this setup, and I'm willing to initially place here a trade with the risk of, let's say, 100 euros, so 20% of my daily stop loss in this case. It all goes down, comes down to the same component here. If you put it that way, have a daily stop loss level, or if you say, okay, I risk 100 euros for each trade I place, you have to adapt your position size accordingly, because volatility plays a very important role. Let's assume you're placing a stop here. In this case, in case of Euro USD, for example, you're placing a stop of 100 pips. So that means that each pip has a value of €1 then. So you have to make sure that you do not exceed a pip value of greater €1. If you have a 50 pips stop in this case, and you want to place a trade with a risk of 100 euros, should go with the saying that your overall risk shouldn't exceed per pip, the pip value shouldn't exceed €2 per pip. Okay, so but you have to adapt the position size accordingly. So in the first example, we had to reduce the position size. In the second, we could increase the position size, but we have to make sure that the pip value does not increase beyond a certain number, which is then exceeding our overall risk we were willing to take before entering the trade. The next thing, very interesting aspect, in fact, placing a volatility stop. So place a stop based on volatility. I already presented the combination between these two in the first component here, having an equity stop, but using volatility as a tool to find the right position size. But volatility stop can also be understood in a different way here, in fact. So for example, I place my stop based on the current ATR 14. So by the way, I don't really know, but I think we had a webinar on volatility too, right? And here on ATR and how I place my stops based on ATR. I'm not really sure, but if you ask me now and put a gun to my head, I'd say 70% that we had this webinar. However, so the volatility stop based on ATR. So ATR is short for average true range, and gives you an idea on the average width or the average length of a candle for the last 14 periods, depending on the time frame you're in. Let's say you have an hourly chart. So if you look at the ATR 14, it means you look at the last 14 hourly candles in this case. And let's assume that your volatility stop then in this case is something like based on the ATR 14 and tells you ATR is 15, and then you put in a multiplier of 2 or something, then you have a 2 ATR 14 stop to make sure that once the market you're trading, USD, GBP, USD, whatever, that then the stop width is far away enough so that you do not risk to be stopped out by a coincidentally move, let's say. So, or that you place your stop within the noise of the market. We can also call it that way. I, for example, trade an approach. It's not an FX approach, but I do this in the DAX, for example, where I use, in fact, the volatility-based stop. And my position size is calculated accordingly to volatility. So in this case, I enter the trade, and then I have a stop a level given based on volatility, predetermined, and then it makes sure that my position size is placed accordingly so that I'm, for example, not risking more than 0.5% of my overall equity on this trade. And the next one is, and we'll dig into more details in the next or the slide afterwards, in fact, once we place a stop based on technical analysis, for example. So a very simple rule for that is, I'm sorry, by the way, I haven't prepared this, but to just give you a rough idea, I think everyone can really understand already what I'm talking about. But let me just do this very roughly. 1 second, please. So you have a sequence of higher highs and higher lows. So this is an uptrend, obviously. And now you ask the question, if you position yourself long for whatever reason, when is the moment when this structure, this long sequence is broken? So that could be, or will likely be, if you place yourself long here, for example, and see the market moving your direction, still the sequence would be broken here. At least it would be broken there once we push below that level, once we break below that level. It depends on how we break below that level, by the way. So if we just spike lower like that, so this is now price action theory or Dow theory to some extent. It's another very important and very interesting topic, in fact. But just imagine that you're just spiking below that level. That does not necessarily mean that the trend is broken, but it's more like a full retracement in this case, with probably a short spike. There's a full extension and full retracement of the former progression move in this case. So this is not breaking the sequence, in fact, since we have easily, and probably have seen that, quite often we get to see a spike below the recent relative lows, which indicates that the structure, the sequence is interrupted, but it's not really broken. It's broken once the market really builds a sequence of falling highs and falling lows and breaks below that level. So then we can talk about the trend being broken in this case. Another way to do that is to say we have to have a certain percentage move below the last relative low to break this sequence of higher highs and higher lows. So you see, it's a definition question. So we can get quite a complex within a very short period of time. All I wanted to do is here to give you just an idea on where to place the stop. Beside that, by the way, if you're trading equities, also something which is probably of interest to you. Some of you might wonder, is there special ways to place stops? So markets behave differently. So the sequence of higher highs and higher lows, a trend is a trend, whether you're talking about an index, whether you're talking about gold, Forex, or you talk about whatever asset class. But there's some adaptations which are useful and which make definitely sense. For example, if you're trading stocks, you want to avoid to place your stop directly on, respectively, slightly above a round number. So let's assume the number is 39 or something. Okay, so if you if you place your stop now at 39 or slightly above that level, 39.05, 39.10, for example, it can happen quite often, in fact, that you're getting stopped out shortly before that number or around that number, since institutional traders are buying against these round numbers only to see the market then reverse again from 30.01 or 30.00 or 38.99, for example. And you see the market just spiking into that number and then just reversing and moving in your direction, which means that you should avoid placing your stops at these round numbers, especially probably if you're a short-term trader. So avoid to place your stops at a round number or shortly above that round number, but use a stop which is slightly below that level. So 38.95, 38.90, for example, but avoid to place it directly on the round number. That's something which it comes straight away to my mind, which I would avoid if I trade stocks, for example. So just a further idea on to trade with a stop loss. So number one, trade with a stop loss, our risk and money management tip number one. So the second one is work with trailing stops to secure profits, respectively, put a slash behind that, work with partial take profits in this case. So in fact, it's not uncommon that, especially among beginners in Forex trading, there's no real active trade management, for example, by using a trading stop, but it's more like a make or break approach. It's not that I don't trade strategies who are looking for these make or break setups, which means you enter the trade and then you have a stop and you have a take profit. And there's two ways to exit the trade. First one is you get stopped out. Second is you reach a take profit. So there are trading approaches which work that way, but most discretionary approaches in trading, especially. So if you're not trading fully automated here, give you a chance to secure at least some of your profits by using such trading stops. For example, so once you have opened a position here and then you have a floating profit, for example, of let's say 500 USD, you move your stop loss to the current price or closer. No, closer to the current price. No, you don't want to get stopped out. You want to let profits run, but still you try to get out of you try to get out the risk out of the trade, but still try to profit here from further momentum in your direction, and which means in this case, if this stop level then you trailed your stop to is hit, you would close out the position at least with a small profit. Respectively, if the trade keeps going your way, you can continue to trail the stop after the price. And this does something interesting with you from a psychological perspective, in fact. So which means in this case that you're here, you try to, how to say that, to trade out of a more relaxed mind, for example, by knowing that you do not risk any money anymore in the trade. For example, trading the stop to break even. So that can be very powerful in your trading. But it's not sad that you don't feel frustrated if you really get stopped out break even then. Because the thing is, and this is something we also made a topic in one of our Trading Spotlight webinars, loss aversion is a big topic. Loss aversion means that you're weighing your losses higher than you enjoy your profits of the same size, which means nothing more than, let's assume you have 100 euros and you're losing 100 euros. To compare the pain you feel losing 100 euros, you have to gain 200 euros and put this in quotation marks. It's to break even on the trade. Okay, so that means if you, for example, see a trade moving $500 in your direction and you trail your stop to break even, and you're then stopped out, you're breaking even. You can look at your account balance. Okay, so you can see you didn't lose any money on the trade, but it feels like a loss. And this is something which is quite common and shouldn't be underestimated in your trading. So which is one of the reasons why I start, especially when starting with trading and looking at beginners, to find ways and to teach, to coach these beginners in a direction which makes it possible for them to at least have partial take profit being implemented in their trading strategy, to make sure that they see at least small gains, which keeps them motivated to keep on learning, and which keeps them also in the game from a cash flow perspective in this context. So something which is also very interesting then from a mental trading perspective, in fact. And what I have now is to give you an idea, even though it's just purely theoretical, so I haven't prepared a chart for this, but I want to show you how such an example of a trade-based stop management, active stop management, can look based on a price action in this case. So what I do is I divide the chart we look at now in two ways. So first we have a dominating time frame, and then we have our traded time frame. So for example, if you prepare to trade a 5-minute chart, your dominating time frame is the hourly chart. If you trade the hourly chart, your dominating direct dominating time frame is the daily chart. In case of FX, since we are mainly focusing on forex trading here, you will most of the time look at a 4-hour chart. This is due to the rollover, and that the FX market is open 24/5, in fact. So, and you can better divide, in fact, 24 hours by 4 than by 1 in this case. And in addition to that, also what I like to say is that forex markets are known to be quite stable when it comes to trends. That's probably a fair way to put it. And looking at a higher elevated or higher time frame here makes perfect sense. But it doesn't really matter when it comes to active stop management, what we don't want to look at here. So we have our dominating time frame. Let's assume it's an hourly chart. We have a higher sequence of higher highs and higher lows here. And here you can see that I put this in red, and here I put this in green. And what I do now is I want to look at what's happening here at the lower time frame. So we zoom out, we zoom in. I'm sorry, no, we zoom out. We zoom in into the chart here, and see that on a traded time frame, our time frame, we have a sequence of falling highs and falling lows, and then here this is the green sequence which starts here. And what's now getting interesting is that obviously this sequence was broken. So the sequence of falling highs and falling lows was broken with our time frame pushing above the last relative high here in this context. Now, meaning if we position ourselves long, we position ourselves with the overall advantage with the dominating time frame. And so what we could do is we could think about entering the trade by a bounce back to the last relative low, former resistance, which is now becoming a support, and place our entry here. Now we have our stop there below the last low, because we know this sequence is obviously not yet done, but chances of a deeper corrective move are still given and higher probably then. So we place our stop there, and this is obviously our risk. So if we enter here and we place our stop there, the difference is our risk. So now what we have here, this is the former high in a dominating time frame. So this is where the sequence of falling highs, the red sequence starts, in fact. So now what we do is we at least hope, or we bet, let's probably put it that way, we bet that the market will, in this case, the currency pair, Euro USD, Pound USD, USD JPY, whatever currency pair you're trading, will attack this region of former highs again. And then what's happening here is that once the market does exactly that, you can now see that the market moved 1R in your direction. So the risk here can be defined as 1R. And if the market now moves 1R in our direction, let's assume 1R is 100 euros, and now the trade is 100 euros ahead for us and is showing 100 euros profit in our P&L, floating profit here. We can trail our stop here to break even, to the level where we entered the trade, and take out the stop, take out the risk of the trade, and in fact then relax and see what happens. Will we break to higher highs? If this really happens, we have a very favorable environment in which we position ourselves, and hopefully we'll see a continued trend, an acceleration on the upside with new highs, which will then give us a chance to keep on trailing the stop, respectively think about potential partial profit taking or profit taking in general once we head to a projected target on the upside. Then let's have a look here at the leverage and the limit of the use of our leverage. So in fact, based on my personal experience, inadequate leverage is probably one of the main reasons for the majority of Forex traders, but traders in general, why they're unprofitable. So what is leverage? So leverage offers you the opportunity to magnify your profits, but it can similarly also magnify your losses. So there's no free lunch or something like that out there. But if you use leverage, yes, you can magnify your gains, but on the other hand, you can also massively magnify your losses. And this is nothing more than increasing the potential risk for your trade. And so in this context, let's have a look at an example, a simple example. So a classic retail account has a limited leverage now after the so-called ESMA decision of 1 to 30, meaning that with 1,000 US dollar, you can place a trade worth up to 30,000. So multiply your account balance or your deposit of your account by the leverage which is offered by your broker. So Admiral is, as every other broker too, after the ESMA decisions for retail clients offering a leverage of 1 to 30 for FX major pairs like Euro USD, GBP USD, dollar JPY, and so on and so forth. And meaning that you can multiply your account balance by 30, and then you get the theoretical the theoretical amount you can move in the market, in fact. And so this means, in this case, if the market now moves 1% in your direction, in your favor, you make 1% on these 30,000, which means you make $300, which means if you look at your 1,000 USD investment, your initial investment you did, 300 USD here, as shouldn't be a surprise, it's 30%. 300 on 1,000 is 30%. And now the other side of the equation obviously shows that also your potential losses are magnified, because if now the market drops here by, let's say, 1%, you position yourself long, drops by 1%, the 1% is still on the 30,000 you're moving within the market, you're losing 300, which equals to 30% of your initial investment of 1,000 US dollar. And now the question might be at your end, okay, what can I do? Is there a simple rule of thumb, let's say, or calculation I can take into account once opening positions? And in fact, yes, there is. There's a rule of thumb which plays out quite well based on my personal experience. What I like to do is to look at the so-called effective leverage. And this effective leverage should not exceed a ratio of 1 to 10, which means nothing more than, let's assume you have 10,000 euro in your account. And if you now look at your open positions, you have your market exposure. Let's assume you have 10,000 euro USD, you have 1 million lot euro USD long, you have 1,000, not 1,000, but 10,000, so 1 mini lot GBP USD long. You are also long USD JPY, for example, for 20,000 units. So you have 10,000 plus 10,000 plus 40,000, which equals to 20,000. 10,000, 10,000, 20, which equals to 40,000, and your account balance is 10,000. This means that your open market exposure in this context is 40,000 units you're trading divided by 10,000, your account balance, which equals to 41. This is smaller than 10 to 1, which means you're working with an effective leverage within your overall account balance in this case. So you're not over leveraged. Once you exceed 10,000 and 100,000 units in this case. So let's assume that the position or market exposure, Euro USD, GBP USD, and dollar JPY exceeds 100,000 units, 150,000, 200,000 units. And you're not trading, let's assume, I don't know, one mini lot in Euro USD long, but you're trading one lot. So 100,000 units, one lot GBP USD you're long. And you're long another 200,000 to 2 lots dollar JPY, then you have 100,000 plus 100,000 plus 200,000, 400,000. You divide this by 10,000 and you see it's 40 to 1. This exceeds drastically your effective leverage of 10 to 1, which means you're over leveraged in the market. And so reducing this size. I haven't prepared a chart right now, but I have a chart in mind, in fact, a graphic which perfectly illustrates this, increases your chances of your overall profitability, as respectively, at least you allow yourself to make mistakes by an enormous factor, in fact. So you have really a great chance then to stay in the market long enough to overall develop your edges and let these edges play out to increase your overall account balance. If you over leverage your account, your potential the room for mistakes is just too small, especially for an inexperienced trader, to put this in quotation marks, to live long enough in the markets to let the edge play out, in fact. Then have a realistic profit expectation. This is probably now the interesting part, which I already mentioned at the beginning. The Trading Spotlight webinar we run several months ago on Monte Carlo simulations. And what I did here within this webinar was I introduced Monte Carlo simulations and told you to imagine these as flipping a coin, in fact. So Monte Carlo simulation can be seen as flipping a coin here. And what you do is you generate different series of pitch and tosses and thus equity curves. So you say a winning trade is a 1, a losing trade is a 0, and then you have based on your overall hit rate, you can say, let's say 50%, for example. The market is then running a series of, let's say, 100 trades or something, and then has 50 winning trades, 15 losing trades on average, and then gives you an idea of what can I expect if I have now a running series of, let's say, 10 losing trades in a row, which can easily happen, by the way. And I can show you here in this context in a few seconds. I will share some links here with you on Monte Carlo simulations. I want to come back then also to one Monte Carlo simulator I used here from a website I set up with a book I wrote in the German community. So it's not of use for you because this is an English-speaking webinar, but we want to use the Monte Carlo simulator from this website to illustrate how to draw a realistic profit expectation based on theoretical numbers, but still not have overly optimistic expectations to become a millionaire overnight. Let's say once you start trading now, if you deposit, let's say, 1,000 euros in your account. There are several YouTube videos out there who doing exactly that, telling you how rich you can get within no time by just using the leverage which is provided by your broker, which doesn't make sense at all, which is very, very risky. And to not fall into this trap here, these Monte Carlo simulations can be very, very useful, in fact. So let's come back now to the proven profitable trading strategy. You hopefully have already formulated with clear input parameters like the payoff ratio. So average winning trade compared to the average losing trade, but also the hit rate, for example. And then what you can do is by just having these two numbers, so payoff ratio, or the ratio of average gain to average losing trade, and the hit rate, you can then simulate different equity curves based on different arrays of winning and losing trades. So a series of ones and zeros, in fact, you sum up. And that helps us, in fact, to somehow stress test our strategy and see what we can expect under different market conditions. What is meant by different market conditions? Very simple, in fact. Different market conditions means if you're trading a trend strategy, for example, it will naturally not work well under range-bound market conditions. If you're trading a range-bound or range trading strategy, it will certainly not perform really well under trending market conditions. And such simulations or Monte Carlo simulations help you to simulate these different environments which happen. It's just natural. It just happens. And so that helps you then to have a clear picture of what you can expect naturally, which naturally results in a solid mental fundament based on which we can build then our trading business on. This is, in fact, what it all comes down to not get overly excited if trading this or that strategy, but to keep calm and keep a realistic profit expectation. So first of all, now let's go back here to, this is the next slide. So in fact, this is how it looks like. This is from the website. It's a screenshot from the website. Let me just here share first of all the link to Monte Carlo simulations. So one sec, please. So this is the webinar. Trading Spotlight webinar. I'll share it here within the chat box. If you watch the recording now on YouTube, I called this Trading Spotlight, by the way, Trading Spotlight MCS. Then please check the description box below the video for the link here. And if you then click on the video, you can also find here the link to the Monte Carlo simulator, which I just screenshotted. So you just have an overview how this looks like. And as you can see here, this is German, so it doesn't really work. But please check out the video to get an idea on how to use this. I think it's very useful. What we can do is here, just let me run one simulation so you have a better idea of what's happening here. So you put in your starting account balance, initial deposit of your account, let's say 10,000 euros. And then you simulate, let's say 250 trades you want to look at. And you have a hit rate here of 50%. You create 15 different equity curves. So 15 different arrays in this case of winning and losing trades. This is how you can understand that. Here's the payoff ratio. Let's assume it's 1.6 to 1. Okay. And then we have a risk per trade of, let's say, 1%. And then what you can do is you can start running the simulation. You see very nice that all equity curves are showing significant positive performance. So the lowest is here at plus 50%. Let me just see, do we get, so you can see it changes since we have different areas of winning and losing trades, ones and zeros. We place here. And yeah, as you can see, this is highly profitable, and I can explain to you why this is highly profitable, because you have a hit rate of 50%, while here you let your winning trades on average be greater than your losing trades. So this is the only secret behind this. So there's no big surprise that we get to see such a developments here. But let me just do 1.2, for example. So you have at least one negative one here. There we go. So if you decrease the number, or not the number, but the average winning trade too much in this case, so you're still profitable. There's no question about that. Here you have the Erwartungswert. It's the expected value. It tells you whether what you're doing here is profitable in the long run or it isn't. But still, you can see that not all equity curves are above zero after 250 trades. And that has to do with the fact that the average winning trade is too small, and you don't let the winning trades run long enough to create such a significant, beautiful outcome as we had here in the first step. So this is how you can imagine that, and how you can draw your expectation based on the next, let's say, 250 trades, and not fall into this trap here of thinking I'm getting rich quick here because I'm trading a trend following strategy, whatever. There will be times once the performance is not that beautiful, and even if the strategy is positive, that's like running an ice cream business on a beach. Okay, so just imagine that you're running an ice cream business on a beach. I think no one here will question whether you will make money in a hot summer with running an ice cream business at a beach. Okay, you will certainly make money, but let's assume now it's a rainy day, or it's a cold summer, or it's winter. Well, you have a profitable business over the months of summer, between, let's say, May to September or something. But if it's rainy, if it's cold, if the winter sets in earlier, or if the summer is a cold, well, you can have a profitable business, which no one will question. But this is just not the right environment in which you can run your business as profitable as you could once the summer is hot, right? So this is the same when it comes to trading. And Monte Carlo simulations here in this context, to just close this, can help you to draw a very good and realistic picture of what you can expect in your trading. So play around a little bit with this. I think that makes definitely sense, and can put your overall trading on a very solid mental, what's the word for this? On a very solid mental fundament. Yeah, that was the word I was looking for. And now let's have a look here at the last aspect: diversify your forex portfolio. So as I already said at the beginning of this webinar, don't put all of your eggs in one basket. which is not just true when it comes when it comes to an equity portfolio diversification. So not putting all your eggs in one basket. Have growth titles like Tesla, like Amazon, like Apple, like Netflix, and just see, as we've seen from the March bottom of this year, the market shooting up through the roof. I just saw a video on Twitter. It was an interview which was published, I think, on Bloomberg. There was a guy who said, in 2017, I just bought some Tesla stocks and put 10,000 US dollar in Tesla stocks. Hey, today I'm a millionaire. Yeah, that's beautiful. But there will be some pretty sick swings, I could imagine, you have witnessed over the course of the last, let's say, 2 years, 3 years. Certainly, you're now a millionaire. But if you now start to buy Tesla at these elevated levels, certainly you could get lucky again, and then we see the market shooting through the roof. But still, you should wonder whether this portfolio diversification, which is not there because you're just invested all your money in one stock, whether it could weather a next heavier storm, let's say, with growth titles coming under pressure. The same is true for Forex then in this case. So which means that Forex and trading different FX pairs in this case, Euro USD, dollar JPY, in fact, or also GBP, Swiss franc, GBP, Australian dollar, GBP, and NZD. These are the ones I can, which come to my mind now. NZD, Canadian dollar, Aussie against Swiss franc. So these cross pairs, and also different strategies here, which are all traded based on a solid risk and money management plan, can help you diversify your portfolio and in fact create let's call this all-weather portfolio, in fact, given a basket of different currency pairs you're trading against each other with different strategies, and then create a quite solid payoff, which is not related to classic, let's call it market developments, let's say, but which is running independently from market conditions. And by having diverse range of investments, you protect yourself. As I already pointed out, in other words, you protect yourself in case of the market dropping. In fact, in one currency pair, the currency pair drops, you're long, you have a solid risk money management, you're working with a stop. On the other hand, it's compensated, not just that you're working with your stop and you limit your loss here, but also in addition to that, you probably limit the drawdown in your account by having another strategy which performs well under these market conditions here. And hopefully this is what we aim on when we look for diversification. We try to compensate our bad running strategies in the current environment by good running strategies. In fact, hopefully experience not just a stronger performance, but a performance which outperforms the negative performance of the bad strategies. And yeah, with that in mind, you can manage your risk in your Forex trading, ensuring that Forex trading is part of your overall trading portfolio. And so let's have a look at the summary here. So first of all, we pointed out the top 5 tips for Forex trading in regards to risk and money management. And they were: trade with a stop loss, should go without a saying, but also work with actively trade, which means, for example, secure profits by working with a trailing stop. In fact, limit your use of leverage. I gave you a rule of thumb of 10 to 1. If your overall market exposure exceeds 10 to 1, then you should become very careful, probably reduce your overall market exposure. Have realistic profit expectations, especially. And also diversify your Forex portfolio. And I think if you are looking to make sure that these top 5 tips of Forex and are in your Forex trading risk and money management tips are part of your trading in 21, I think you have a solid chance to perform quite well, and also to weather any storm which might be ahead of us in 2021. And oh, I'm sorry. I forgot to include this. Let me just look this up here. I'm sorry. I forgot to include this. So Monday, the 20, let me just see. Let me just see. Oh, this is surprising. I thought 23rd. Usually there should be, Paul, no, on the 21st. So, well, there's no webinar then on the 21st. I'm surprised now. I thought that probably on the 21st there will be Paul here, but Paul seems to be on vacation. Paul will be there on the 28th, in fact, and so after this Christmas week now. So the next webinar will in fact take place on Wednesday, and it will be together with Marcus, and he answers the question of why you should trade major currencies. So this is the topic from Marcus on Wednesday. So please ignore what you just saw here. What you have to do if you watch the recording now on YouTube, please go over to admiralmarkets.com to the Education's Webinars Top Trading Spotlight, register there. If you are here in the live event, then check your inbox for the webinar link. Again, not Monday, the 21st, but on the 23rd of December, with Marcus talking about here, or answering the question why you should trade major currency pairs, and then including, for example, understanding the major currency pairs in Forex trading, how to read currency pairs, liquidity in trading major Forex currency pairs, benefits and cons, pros and cons of trading major currency pairs, and also answering the question whether major Forex pairs are a good place to start, in fact, for beginners. Further information on the webinar series, admiralmarkets.com. Here you have the contact details if you want to reach out to Admiral Markets directly. And this is the risk disclaimer. So that's it from my end. I wish you Merry Christmas, and hope to see you again in 21 on Friday. Then I hope let me just check, I think it's the 8th of January. And that's it from my end. So happy trading. Watch your stops. Merry Christmas to all of you, and talk to you soon. See you. Bye-bye.